So let's start with the DNC list, the Do Not Call Registry. The Do Not Call implementation law was signed into law back in 2003 as part of the telemarketing consumer fraud abuse. See, if you are calling someone on the telephone to market your services, that basically makes you a telemarketer, and you fall under the guise of this rule. As a loan originator, sometimes you buy leads and you call those leads on the telephone to market your service. So because you're calling them on the telephone to market your business, that makes you a telemarketer, and you have to make sure that you're following the Do Not Call Registry rules and regulations. Sometimes you go to work for a new company and they give you a list and they say, call these people to see if they want a loan. Well, again, you're calling them on the telephone to market your business, making you a telemarketer, which is why you have to make sure that you understand how the Do Not Call list work. Now, the law was intended to allow consumers to restrict unwanted sales calls from coming to their homes. That was the entire purpose of this law when it was initially implemented. Today, the Federal Trade Commission, the Federal Communications Commission, and many of the states enforce what's called the Do Not Call Registry, the DNC list. Many mortgage professionals have successfully forged new business relationships by doing what's called cold calling to their prospects. You buy leads, you buy lists, you give them calls. Loan originators must exercise particular care in order to avoid violating the restrictions of telemarketing. That's why we want to make sure that you're completely aware of what those rules and regulations are. To keep from violating the Do Not Call regulations, a company must maintain both a national Do Not Call list and an internal list of customers and prospects, and keep it updated on a regular basis. The national Do Not Call list can be found by going to the internet and clicking or typing donotcall.gov. But each company must also keep their internal list of consumers that may have called them and have said, don't call us anymore. Or once you have called them, they say, they're not interested, don't call us anymore. They're supposed to maintain an internal company list of customers that don't want to be called. Both the national DNC list and the company's internal list must be updated every 31 days, and records of the documentation must be maintained for a period of 24 months. Violators could be fined up to $42,530 per call, as each call, not each day, is considered a separate violation, a separate incident. Again, violators could be fined up to $42,530. This has changed a few times. It started out as $10,000, then it went to $16,000, then it went to $32,000, then it went to $41,000. But as of now, the violation for calling someone on the Do Not Call list is $42,530 per call. Telemarketing calls can only be placed between 8 a.m. and 9 p.m. in the time zone of the consumer being called. So you have to be careful about that. The Do Not Call registry does not limit calls to politicians, political organizations, charities, or telephone servicers. The DNC Safe Harbor Rule. The DNC recognizes that everyone makes mistakes, and companies won't be held liable if they have the following things in place. If they have a written Do Not Call policy, they may not have to pay the fee. If they have a written policy which they train their employees on, where they've warned them about this rule, they may not have to pay this particular fee. If they train employees on a regular basis regarding the policy, and of course they're going to have to show proof that they do this, but if they train their employees on a regular basis regarding the policy. If they maintain an internal list of customers who've requested not to be called. If they show proof that they've accessed the registry every 31 days. and updated their list. So their internal list must be updated every 31 days. Also, they must be able to prove that the call was made in error. The established business relationship, EBR rule, as it relates to the do not call list. Because if a person or a consumer has an established business relationship with you, an EBR, the rules and regulations differ a bit. So an established business relationship, the requirements, DNC and its provisions do not apply to a consumer if you have an established business relationship with a mortgage professional. Meaning, if you have actually closed a deal with that person or done business with that person, you have what's called an EBR, an established business relationship. And some of the do not call list rules don't apply if you have a established business relationship with a consumer. This established business relationship can be established in one or two ways. The first way, 18 months after the consumer's last purchase or transaction with you, then you have what's called an established business relationship, and you can call them, even if they're on the do not call list. So let me say that again. Even if a person is on the do not call list, but you actually close business with them, even though they're on the do not call list, because you actually close business with them, you have what's called an established business relationship, an EBR, and you can call them for 18 months. So if the consumer purchased, rented, or leased goods and or services from the seller, or participated in any financial transaction between the consumer and the seller within 18 months preceding the telemarketing call, then that would not be a violation of the do not call list. They have what's called an established business relationship, and they can be called for up to 18 months. 3 months. Maybe you didn't close business with them, but they did an application or an inquiry with you. Then you can call them for 3 months, even if they're on the do not call list. For example, can I help you now? Are you ready now? You can do that for about 3 months. If they close business with you, you can call them for 18 months. But if they did not close business with you, and it was just merely an application or an inquiry, then you can call them for 3 months, even if they're on the list. So it says 3 months after the consumer makes an inquiry or submits an application to the company within 3 months preceding the telemarketing call. That wouldn't be a violation. However, regardless of the existence of an established business relationship, if this consumer specifically says don't call them anymore, they don't want to be contacted, you have to stop calling them. You can't say, oh no, you closed business with me, I can call you for 18 months. No, that wouldn't work. If they tell you to stop calling, you must stop calling.